Hey guys and girls, it's Daniel Walsh from Your Property Wealth. Today we're talking about deposit sizes for an investment property. And we're talking about people that are trying to get into the investment property space. They haven't bought an investment property. They might be rent vesting and it might be their first investment property, or they might even have a couple of properties but they're struggling to get another deposit together for another investment property. I want to talk about what deposit sizes you should be using. Now, it's always a common theme that most people want to use 20% deposits because they want to avoid lender's mortgage insurance. So I want to bust a couple of myths here and say that it's actually sometimes more beneficial to pay a 12 or 10% deposit and pay the lender's mortgage insurance than it is to pay or actually save up the full 20% deposit. Now, for me, I was actually investing, a lot of my career I've been investing with 10 and 12% deposits. I've been able to build a very significant property portfolio doing this and using this strategy because I was able to get into the property market a lot earlier. So what that meant was I could get into, instead of buying say one property with a 20% deposit, I could go out there and buy two properties, and then as those two properties rose in value, I could release the equity and then go buy another two properties. I was able to do this a lot quicker because I wasn't saving up the full 20% deposits. But what you could do is you can use this same strategy even if you're starting off and you're trying to build up your property portfolio, because you can get into the property market a lot earlier. What I'm saying here is that if you were to say save up a full 20% deposit, or you put a 12% deposit down, it means that you don't have to save up the extra 8%, which can often take a couple of years to do. And in that time, the property market could have moved. And if it moved 5 or 10%, then you've got to continue saving to try and get that 20% deposit. So it's all about getting into the market as early as you can and being able to do that in a safe way. Now, when you actually say go use a 12% deposit or a 10% deposit, now you're going to have to pay lender's mortgage insurance, and that's what people want to avoid. But when you're actually investing and you pay lender's mortgage insurance, it is tax deductible. So that means that over a 5-year period, you can depreciate the lender's mortgage insurance so that you actually get some of that back in your tax at the end of the year. So it's not all lost. The other thing is as well, once you actually pay your lender's mortgage insurance, it gets capitalized onto the loan. So it's not something that you physically have to save up for in order to pay. What you do is when you get your deposit, you get it ready, you go out there and you buy a property, they will capitalize the lender's mortgage insurance on top of the loan, and you will just have to pay interest on that $4,000, $5,000, $10,000 or however much it is for the lender's mortgage insurance. And often that's just a couple of dollars a week. So for a couple of dollars a week, you can get into a property saving yourself 8% and being able to get into the property market a lot earlier. That's how you can build a successful property portfolio, is being able to get into that property market a lot earlier and being able to be effective with the money that you have. Anyway guys, this is just it, what we've got for deposit sizes. And if you like all my videos, please like, share, and comment. And until next time guys, have a great day.